The purpose of this video is to do a graphing review of the money market graph. The first thing you want to do with the money market graph, like with every graph in this class in AP Macroeconomics, is you want to get the labeling down. So in the money market graph, it's a nominal interest rate. It has to be a nominal interest rate on the vertical axes. A lowercase I, for the most part, will get it done. I would write out nominal interest rate at least once on the AP exam or on any test before you ever deal with this. On the bottom of the money market graph is quantity of money. Okay, the investment demand curve is quantity of investment. Loanable funds graph is quantity of loanable funds. So they tend to be pretty obvious or intuitive. If you ever get in a jam, just kind of think about what's the name of the graph, and then that should help you a little bit at the end. The demand for money is like most demand curves, slopes down and to the right, if not all demand curves. It tends to be drawn more as a straight line. You can tell when I learned how to draw my graphs, as we've gone through this all year, they tended to be a little more curved, and so you can still see that. Either way, it's fine as long as it's sloping down and to the right. And if you think about it, it makes sense. Money is like almost all other goods. As the price of money, or the interest rate in this case, gets lower, people want a higher quantity of money. As the price of money increases, or the interest rate goes up, people want to buy less money, okay, in terms of quantity demanded. What would cause the money demand curve to shift to either increase to the blue line or decrease to the red line is actually, I think that's the green line. I realized someone played with my markers. So anyway, the green line up there, what would cause it to increase to the blue line would be anything that would cause the demand for money to increase. So if there's fears of inflation, so they demand more currency for transactions. They're maybe more optimistic about how the economy is, so they're going to borrow more money and spend more money. On the other hand, what would cause the demand for money to decrease? It may be institutional changes. There's just the requirement for cash is less than it used to be due to ATMs or online banking or the use of credit cards or something along those lines. Maybe people are pessimistic, and so they don't want as much money for transactions because they're just not making as many transactions. So all of those things, and they tend to be kind of obvious and, as I said, a little intuitive. Should I increase my demand for money or decrease the demand for money? If they ask you to draw a money market graph and the Fed is not involved, most likely that means then you have to move the demand for money around, or a central bank is not involved, I guess it should say, not just the Fed. Okay. All right, so let's take a look at the money market. The supply of money is a vertical line, and this is true in all advanced economies that have central banks. The money supply is a vertical line. Why? Because there's one issuer of money in most countries. In our country, it's the Fed. In the European Central Union, it's the ECB, the European Central Bank. In Japan, it's the Bank of Japan, so on and so forth. And so anytime you draw the money supply, it is vertical. Now, what you should understand is only a central bank, in our case the Fed, can impact the money supply. And the tools that you need to worry about increasing the money supply are open market operations, okay, and that's the buying and selling bonds. Buying, selling bonds. This is the most used tool, the most commonly conducted policy. It happens every day. Millions and millions of bonds exchange hands. They could lower or raise or so we'll just say change the discount rate, which is the rate the Fed charges banks to borrow directly from them. In real life, it's less used, although since 2007, 2008, that's kind of not true anymore. And they could change the reserve ratio, which is the percentage that banks must keep of demand deposits in their vault or on reserve at the Fed. Okay, so you should be familiar with all those tools. So anything that's considered expansionary is going to increase the money supply. So it's going to cause the blue line here. Okay, so expansionary policies would be buying of bonds, would be lowering the discount rate or lowering the reserve requirement. And the reserve requirement one, while it rarely happens in real life, they don't like to change the reserve requirement. We talked about this. one thing that you might want to keep in mind is if they talk about, like, if they say that somebody had like $30 million in cash and then they put that in the bank, while the Fed didn't do anything directly or a central bank didn't do anything directly, the fractional reserve banking system is now going to allow the money supply to increase. So while if you read in that scenario, so what will, usually they'll say, like, what's the initial change to the money supply from the deposit even of $1,000? And the answer is nothing, because it goes from cash to checking account. That's just moving around in M1. There's no change. Then once that money starts getting loaned out and redeposited, loaned out and redeposited, depending on the reserve ratio, it's going to cause the money supply to change. So in those scenarios, the money supply can move even if the central bank is not directly involved, because the central bank has set up this reserve ratio, which in our fractional reserve banking system allows the money supply to be increased or decreased. Now, if you look at the red one up here, this is the decrease in money supply. Okay, it's going to go to the left. You can see the impact on interest rates there. What's that going to mean? That's going to mean the selling of bonds. Okay, selling makes the money supply smaller. Buying makes it bigger. That'd be raising the discount rate, so raising the price that banks get charged to borrow directly from the Fed, and raising the reserve ratio. Banks are not allowed to loan out as much money as they could have before. And so once again, the import of these changes is to see the impact, as you can see here, on the interest rate. Okay, so if this is equilibrium here, this is prime, and this is 2, you can see that interest rate 1, interest rate equilibrium, and interest rate 2, there's 3 different levels of interest rate there, and that's going to cause different behavior patterns to emerge because the price of money is literally changing. Okay, and so what is that change going to be? Every time you are supposed to draw the money market, quantity of money, let's just write out nominal interest rate one time. Okay, so if, for example, you are buying bonds, or the central bank buys bonds, you can see what that does to the interest rate there. It lowers the interest rate. And if you put the investment demand curve right next to it, quantity of investment, same interest rate as on your graph, investment demand, you can see that the buying of bonds and the increasing of the money supply, making it bigger, is going to lower the interest rate, which is going to cause the quantity of investment to increase. And then if you just make that connection from here to this graph, aggregate demand, aggregate supply, if you remember, investment, or capital I, is part of aggregate demand, short run aggregate supply, real GDP, price level. So the actions of the Fed in this case are going to cause aggregate demand to increase, which is going to cause the price level and output to increase also, unemployment to decrease. Okay, hope this was helpful. Covers the very basics of the labeling and the movings of this graph.